Hello, and welcome to the Ramp Up to Retirement podcast hosted by Dan Reese. Dan, how are you, my friend? Good to see you.
I'm doing great. Beautiful summer weather we've had, although a little hot here recently, but we'll take it because, it'll be winter before we know it.
Oh, fall is coming. Fall is coming. The days are getting shorter. So, yes, you got cooler weather on your way. But I have to say, here in my part of the world right now in New Jersey, we've had like 3 days of 60-degree nights and 80-degree days and low humidity. It's been like being in heaven. It's been like being in heaven. So I'll take
those
them.
Cool nights are the best, aren't they? You open some
They really
windows,
are.
you let some fresh air in. It's awesome.
Oh, yeah. It's really fantastic. So what's on the table today?
Well, today we've got Brent Oliver, one of our senior wealth advisors, and we're talking about the one big, beautiful bill. So, and if I laugh when I say that,
You're talking about
not
me.
on purpose. Yes, we are. We are. And, but there's a lot to it. And, we've already had a lot of questions come in from clients. And so we wanted to take some time to kind of hit the high points. I mean, there's so much in it. We could not possibly cover the whole thing in one, session. But we're going to try to hit on things that really affect, more like retirees and people that we generally work with so that we can get them that information and try to like clear the fog a little bit. Because like I say, there's a lot in it.
Yeah, there is a lot in there. So I'm looking forward to this.
Dan, I read all 1,000 pages. I thought this was a 14-hour podcast.
Yeah,
I mean, we can do that. I mean,
so we're gonna cut it back. Okay, all right, sounds good.
That's the one big, beautifully. I think we're dealing with one big, beautifully ambitious Brent here this morning, Dan. So.
Yes.
Yeah. That's there's a lot in there. We're gonna focus on the tax part.
Yeah. And it's good. The thing is that with taxes in general, and a lot of these bills, one of the things that's so important for financial planning is you can't do great planning if there's not any clarity, right? And so, we've talked about this, Brent, all these unknowns. Like we have software for tax planning, we have software for financial planning, and what do we have run on all these? Like those, do you want to use the existing rates or do you want to use what they're supposed to go back to in 2026 and all that stuff, right?
Yeah, for sure. I mean, there's so much to this, and I think both of us would say I don't like all the numbers and all that stuff. What we like to do is just try to find ways to help people make the most of whatever law is in play, and hopefully today we can do that. Give some good advice, or maybe not advice is probably the wrong word to use there, but give some good ideas to people about the changes that have happened or some of the things that have just stayed the same.
Yeah, no, for sure. I think that's really important. One of the things that we spend a lot of time on at Avery Wealth is tax planning, right? So this is why we're kind of excited to get some clarity, because as we'll talk about some of these things today, without clarity, it can be really difficult to make really prudent plans, because you're trying to do the best, like you said, in planning for clients that they can pay the least amount of taxes over their retirement. But if you're not sure where that code is going, you can be a little hesitant, can't you, to make decisions, because you're kind of like, well, we think this is what it's going to be, but we're not sure. And we'll get into one simple example. We ran one the other day about how, like a Roth conversion where it looks like may have given a certain benefit to a client with the old rules, with the sunsetting of our current rates next year.
Yep.
That was a little different, wasn't it, with the new rules?
Yeah, for sure. I mean, I think that's a really good point. So what you're getting at is the 2017 Tax Cut and Jobs Act was a lot of that was going to sunset at the end of this year. So when we're putting in numbers, we're guessing, quite honestly. They're educated guesses on what we think is going to happen with the tax rates moving forward, and that can make a huge difference in planning decisions, and just strategies that we're using to help people, mitigate taxes in the future.
Yeah. So let's just jump in. Like, one of the big things that changed, and this is one of the areas it really impacted us with our planning, is the personal tax rates. First of all, what is a tax rate? What's that even mean? Like when you say that.
Well, I mean, so there's different tax brackets, and so everybody for their initial dollars is taxed at a particular rate. It happens to be 10%, and then those next group of dollars just continue to go up. So the bracket that you have has to do with how much total income that you have and where you reside. A lot of times when they say, what tax bracket am I in? That's what highest tax bracket you're in. But those lower dollars for everybody are taxed at the same rates. They just continue to climb as your income climbs. And
So
so,
you're
yeah,
saying whether I'm I was
go
going to
ahead, Dan.
say whether I'm like Jeff Bezos or whether I'm retired and just living on Social Security, we have the same, like all of our initial dollars are taxed the same.
Exactly. That's exactly right.
Yeah. So let's
So
jump in. What's changed with this bill?
yeah. So what hasn't changed really is the brackets aren't changing from the 2017 Tax Cut and Jobs Act. So what the change is that it's not changing, because if this hadn't gone through, we would have gone back to pre 2017 tax rates, which were higher, right? So by extending these tax breaks, the 12% bracket is staying a 12% bracket instead of going to a 15% bracket, or the 22% bracket would have gone to 25. It's staying at 22. So that's a very positive thing for, for everyone, is that those tax rates are not increasing back to the levels that they were before.
Yeah, and so you've done a lot of tax projections with clients. Would you say that's pretty common for families to be in, that you've dealt with, in that 12 to 22% bracket?
Yeah, I think so. We primarily deal with retirees, and so a lot of the people that we're working with are staying in those two, because we're managing those tax brackets to try to help them minimize taxes, not just in a particular year, but over their entire lifetime. So it's pretty common. I mean, some will get up into the next 24% bracket. And you and I looked at this ahead of time, and so just to give you an idea with this, a couple that say is earning $150,000, this tax bill is saving them about $2,200, around that range, in annual taxes. So that's a positive.
Yeah, no, I mean, it is. And I know this going way back, 2017. I mean, it's crazy to think it's been a few years, but I remember when that came out, and we actually ran projections for a lot of clients, like, because they're curious, is this going to help me or hurt me or different things? Because there was a lot of talk in the media that, hey, this isn't really helping average people. It's mainly only going to help really high income earners. But we did find, like what you just mentioned, it actually had a nice impact on a lot of families. So I think we're all happy to know that it's going to pretty much stay that way, right? We're not going to see those increases for 2026.
Yeah, and I
so
mean,
let's
taxes can I mean, obviously this could change, but it takes a lot more. This is a permanent change. So some of the things we're going to talk about are permanent, some aren't. This is permanent. That doesn't mean that, that they can't act upon it down the road. It's possible, but for now, this is what it's going to be, and it makes it a lot easier to make, planning decisions moving forward when we know what it's going to be.
Yeah, yep, absolutely. So the next big thing we want to talk about is the standard deduction. So one thing we know, because going back with tax planning that we've done, is going back to when the 2017 changes took place, the standard deduction got quite a bit bigger. And one of the goals back then was that they wanted most people to be able to simplify their returns. And one of the most complex things in a return is if you can itemize, or whether you're going to take a standard deduction. So let's talk a little bit about what's happened with that with the new bill.
So starting in 2025, so there's different dates for all these things, and so that's where it gets complicated. But the standard deduction for joint married filing jointly is going to go to $31,500. So if this hadn't gone into effect, it would have 2026 would have dropped back to around $26,000. So again, you're getting a little bit more of your income that you can deduct if you are a standardized if you're using the standardized deduction.
Yeah, and which again, I think I don't remember the last stats, but it's a huge percentage of the population that's using the standard, right, versus itemizing deductions.
That's the most common.
So,
yeah, more and more people, because they've raised that amount, it just makes it so much easier, I think, as you said, simplifying it for people to use that. And most people don't have enough other deductions to reach that dollar amount. So This is a positive for most people. I would say for sure.
Yeah, I mean, you think about it. So let's say, I think, you said it sounds like roughly $5,000, and that range is the increase 26 to 31, and that kind of there. So you think about that's $5,000 more of tax-free income in essence, right? Because
Yeah.
your
Yep.
standard deduction's coming right off of the income you earn, and so you're not going to pay taxes on that money. So that's a nice benefit for a lot of people.
Oh, for sure, for sure. And then there's also another little boost in there for seniors. So if you're 65 years of age or older, you're going to get an extra $6,000 per person for your standard deduction as well. So if you're married filing jointly, another $12,000 that can go into that. And so that'll make a big difference for a lot of families.
Oh, yeah. I mean, that's another $12,000. That's significant, right? So,
Yep.
And I mean, we're in Michigan, and you couple that with, some of the changes that have taken place in the state of Michigan. A lot of retirees should have very low tax, issues and very low tax rates overall when you factor it all together. So,
yeah, for sure.
that one's not permanent, right? That's one of those. That's
No,
only
that one
temporary.
sunsets. I think that one is in 2028. Is that might? Do you see
Sounds
that?
like
Dan?
it. I think maybe 3 years.
I think it's
I believe it's somewhere
2028.
around there.
Yep.
Yeah. Yeah.
So that one
But it's a
is
nice.
not. Yeah, it's not that is not a permanent. We're talking about the senior boost. I'll call it a senior boost is not permanent. That's correct.
Yeah. Yeah. So the standard deduction increases and it's going to be, based on inflationary increases as well. So that'll change each year. But the senior boost is only a temporary one.
That's correct. Yep.
All right. Great. Yep. Now, one of the other things, and I remember, like, I go back to, we weren't really affected as much in Michigan, but back in 2017, there's something called the SALT deduction, right? And so that's something that typically, if you live in a state that has higher taxes, higher property taxes, higher state income taxes, that comes into play. So could you talk a little bit about what that is and how it's changed under the new bill?
Yeah, this was a really big point, I think, of contention, is just that some of these higher income tax states or property tax states were not able to deduct as much of what they had paid in taxes and local and state taxes. And so that's what this is. A SALT deduction is going to increase how much you can deduct for state and local taxes from $10,000 a year all the way up to $40,000. So I mean, that is a really, really big change, and helps out, like you said, in some of the higher income tax states and property tax states. New York, California, even really Michigan. There's a pretty big difference in being able to deduct that tax, so that you're not paying it on both the state and the federal level.
Yeah, and especially there's a lot of people like in Michigan we know that might have second homes in Florida, right? And so they might have exceeded that $10,000 in local, between property taxes and state taxes and things like that. So it's interesting. I think that's going to have a pretty big effect on quite a few people, right?
Yeah, it does, because the cap, there's a income phase out that goes along with this, but it's very high income. So the phase out for married filing jointly begins at $400,000, and if you have over $500,000 of income, you're not able to take that 40. But that's a pretty big income, I think, for most people, and so it does allow you to, of course, get rid of some of that tax that you would have been paying if it was at that $10,000 amount, which that had changed in 2017. So it was a huge change for a lot of people. And so we're getting back to being able to write some of that off, and it makes a big difference.
And it is interesting. So it looks like, from what I've read on the bill, there are several things that basically have these income caps, right? So like if you're a really high income earner, we're talking above 500, 600, 700,000, they're not really going to get a lot of these benefits, are they?
Yeah, no, that's true. And I think the media you sometimes has you believe that the only people benefiting from this are the super, super high, income people. And I think this is a good example of where that's not the case, right? If you have really, really high income, you don't get the benefit of this. And $400,000 is still a very, very good income. So people are
Yeah.
still getting the benefit that have high income, but not the people who are making millions and millions of dollars don't have this benefit.
Yeah. Yeah. No, that's interesting. I think that's part of making the math work because the projection is it's already going to add to our deficit, but some of this has offset it to some degree. So it's good to understand that. And the next one that's come up is really important for families that have kids, right? And so, can you talk a little bit about it's called the child tax credit, and maybe even talk a little bit about what's the difference between a deduction and a credit? Because I think a lot of people that can get really confusing.
Yeah, I mean, a credit just is you're basically reducing your taxes by that amount. And so that's a big deal. So if you owed we'll use $2,200 in tax, and you were able to get this child tax credit for $2,200, that's a credit. You would owe no tax. A deduction just is how much it's reducing your income by. So there's a big difference between reducing your income and then subjecting it to tax and actually just reducing your tax bill. And so a credit is going to reduce your tax bill by that amount. And that's what it is. It increased. It's not a huge increase, but I think it's more that it's staying there than anything. So it went from $2,000 to $2,200 for children under the age of 17. And there's another part to this that it does increase and will adjust for inflation moving forward. So that's a positive. And again, this has higher income limits. So married filing jointly, you're eligible for this credit up to $400,000 of income. So it includes more families.
Yeah.
It's always interesting to me though, Dan, that it ends when you turn 17. And I mean, you have kids and I have kids. That's when they're the most expensive.
Yeah.
It's like
You're
maybe a
not kidding.
baby and a 17-year-old are the two most expensive kids that you can have.
Oh my gosh, there's no kidding there. So yeah, it's interesting. It's a great benefit. It really is because you look at like families that might have, 3 or 4 kids. That really, really is substantial in reducing that tax bill. So it's a great benefit, and I think a lot of people will benefit from that. So let's get into
Yeah, I mean,
a little bit about.
three,
Go ahead.
a family of 3. I mean, think of that, 3 kids, all under the age of 17. That's $6,600 in tax credits. I mean, that's a big deal. It is a big deal. So I agree with you. Sorry to interrupt there.
Yeah. No, that's good. No, I think it is. Like people understand that those credits, man, if credit versus deduction, always take the credit, right?
Yeah. Yeah.
That's the lesson there. Well, I shouldn't say always because we're talking about taxes. So I guess there's no absolutes in taxes. But the next thing that came up was these charitable giving incentives, which going back, I just want to talk, rewind slightly. So we were talking about this bigger standard deduction. So typically in the past, right, if you're going to give to charity, that is part of a itemized deduction. But the problem is with these larger standard deductions, that means that for a lot of people, they couldn't itemize, right? So then you get into, hey, I gave to charity, but I didn't really get any additional benefit because it was all wrapped into that standard deduction. So there's been some changes in that area or some additions actually to some existing rules as well, right?
Yeah, I mean, I think that's a great point. When that standard deduction went up, so say you were giving, a few $1,000s, say $5,000 to your church, and you were taking the standard deduction, the 5,000 is eaten up in that standard deduction. You didn't really get anything extra off for giving to the church, for example. Well, now if you're a non-itemizer, let's call it that, because I don't know what else to call it. You can deduct up to $2,000 if you're married filing jointly above for a charitable contribution above your your standard deduction. So if you, in that example that I just gave, if you gave $5,000 to the church, you could still take the standard deduction, and 2,000 of those dollars would be deductible, which is a big, it's a big difference. Because you're getting something, and hopefully it's an incentive for more charitable giving.
Yeah, yeah, and it's interesting. So I think just to take a second on above the line deductions, that's a little confusing for people. But what that is, it's kind of an area of your tax return that allows you to really reduce income before you get into the itemized versus standard deduction, which is it's nice. And there's limitations on it, but it gives you a little bit of a boost to reduce your income before the taxes are applied to them.
Right. Yep. And
So
so
that's a
then,
really
yeah, one thing to note too. So for if you are itemizing your deductions, you can deduct only amount, and it gets complicated, but only the amount above 0.5% of your adjusted gross income. So I would just tell you, if you have questions or anything about that, we're able to, we're happy to talk with you about it. But there's different rules if you're itemizing your deductions. But as we pointed out, most people are taking the standard deduction because they're so much higher.
Yeah, and thank goodness for tax software to be able to calculate all this stuff,
Yeah,
because it's
yeah,
like,
yeah,
I mean, it's really challenging. I mean, I think there are still some people out there that do them by hand, and I just don't know how they do it because it's
yeah.
a real, all these little nuances on the tax return can be a big challenge. But
There's probably a ton of errors,
oh yeah, I would,
in those. I mean,
yeah, yeah. One of the things that we've talked about and we've always pushed with clients to make sure they're taking advantage of is or what are called qualified charitable distributions. So you want to talk a little bit about what those are and how that can play in when you're using that standard deduction versus the itemizing those things.
yeah, I think that's a great point. So for families or individuals, I should say, that are over 70 and a half years of age, it's a government thing. So we'll just leave it at that. You can take money out of your IRA and directly give it to a qualified charity. And you don't count it as taxable income. So you're not paying tax on that. And they obviously are not paying tax on it because they're a charity. And so with these higher standard deductions, the opportunity there is to take the higher standard deduction, still give through a qualified charitable distribution directly to your church or other charity, and no one's paying tax on it. So it's really important. And with these higher standard deductions, this is a real opportunity for people to do that and still get the standard deduction. Is that
Yeah, yeah,
clear? You have
yeah.
anything
It's a
you want to
great,
add to it? It's a
yeah, yeah.
confusing thing,
I
but
think yeah, it's a great
it's a
tool. And it's
no-brainer.
basically allowing you, yeah, it's allowing you to get money out of a account, a pre-tax account, which generally you're going to pay taxes on as money comes out of that, in a way that's really benefits everybody, benefits the charity, and as long as it's qualified charity, that's what matters. But it's great, right? It's a great tool
Yeah,
to
so I
use.
would say
So
we see a mistake a lot of times where people, and maybe this will make it a little clearer, people will give to whatever charity, right? That is important to them. Well, we've seen it before where people will take money out of an IRA, they'll pay tax on it, right? And then they'll turn around and give those proceeds to the charity. And what we're kind of alluding to is that you can just directly send it to the charity. No one's paying tax on it. And they can get more money, and you're not paying the tax bill on it. So it's a win-win for both the individual and the charity. And hopefully that clears things up on that a little bit. But yeah, it's a great tool. And there's rules behind it, as there often is, but if you're doing it strategically, you can really maximize your gift and minimize your tax exposure by doing that.
yeah, and we've got, just for anybody listening out there that is curious if that might benefit them, we've got some really nice software that actually will let us put in like two scenarios. Like you do it the first way where you just take it out and then you give it, versus using that qualified charitable distribution. And we can show you the impact it has on your bottom line. So it's like, it's always good to see. I know a lot of these things we talk about can be kind of like, how does that really relate to me? And so we do have tools to really get you real numbers and say, hey, this is kind of what it might look like for you. And obviously, like that's where a good CPA comes in as well, because they should be giving you some guidance on that too, as far as like ways to reduce that bill. And although sometimes it's tough when you see them at tax time because they just are trying to get through that grind and don't have the time to talk specifically about those things. But one other thing that's come up, which is kind of unique, and I was a little surprised by it, but it's something to do with being able to deduct interest on an auto loan. So what's that all about?
Yeah, this is a completely new thing. I mean, obviously, I think, trying to get it, for U.S. made or assembled vehicles, and so you can deduct now in 2025 through 2028 up to $10,000 a year in interest on vehicles that are assembled in the United States. So it's deductible. It's as we've talked about before, that $10,000 would be deductible, even if you don't itemize. And so it's above the line deduction, which is an important piece of it as well. And so it's interesting, it doesn't include leases, it doesn't include used vehicles. And so that's an important note, and it does have some phase out. So married filing jointly it is around $400,000 where it begins to phase out. And so this is a new thing, right? But it's interesting. And people are kind of confused on it, but you can get the information on whether or not your car is eligible by the sticker, and you have to put the VIN apparently on your tax return when you take this deduction. So it's a totally new thing.
That's really interesting. And I know part of that is to try to encourage companies to assemble cars here, and then also like to buy cars that were assembled here to give you that break. So it's kind of an American pro USA thing, I think.
Yeah, I think so too. And the other thing I would say is that I think it encourages good, financial behavior by the buyers too. If you look at the timing of it, because it does end at the end of 2028. So it's going to encourage people to pay for their car faster, right? Take a shorter term loan, which is obviously, if you can pay cash, that's the way to do it. But you don't want these 7 year loans anymore. So, you have 3 years pretty much to take advantage of this. And so hopefully it encourages people to take shorter term loans as well.
Yeah, good point on that. So let's wrap up with one of the things that is kind of, I think this is a contentious area with a lot of people when we talk about estate planning exemption. So in essence, what can you pass from one generation to the next? That's just kind of at a high level without owing taxes, right? And so originally in 2017, those numbers went up quite a bit, right? And a lot of that was going to sunset. And so kind of where's that stand with the new bill?
So the new bill, it will allow you to pass on per person $15 million, and then per couple would be double that at $30 million. Without the bill, in 2026, it would have reverted back to what it was before 2017 and then adjusted for inflation. And so that would have put it right around $7 million. So it's a little bit more than doubled what you can pass on. And those numbers moving forward will be adjusted for inflation as well. So it's doubled the amount that you can pass on without owing estate tax on the gift or inheritance that you receive.
Yeah, and it is interesting because I know we've talked about this quite a bit. So a lot of for years and years and years, estate taxes didn't really affect that many people because typically, people had pensions and people had, some savings and Social Security. So there wasn't necessarily as many liquid assets or things like that that would count in that. Because if you die at the end of your term, the pension's gone, right? There's no value to it. And so with the advent of the 401k and people really saving and both people, both spouses working and all these different things that have happened over the years, you're starting to see more and more people with much larger estates at death than what, the average person might have had before. And so it's just interesting to watch, I feel like, because, if no changes would have ever been made, I think that those estate taxes would have affected a lot more people that general population would have said, hey, that's not really what we think that the estate tax should affect, right? So it's really
I,
interesting.
Man, I totally agree with that, Dan, because I think in the past it would have been very, very wealthy families, but I think the way that it was starting to really impact middle. I mean, we see middle class savers that get above those other thresholds. I think, where they are now is really not going to be impacting, hopefully, a lot of those middle class families. Then they'll be able to pass on to, to their heirs. And hopefully that's the idea behind it. I think it's a great point.
Yeah. Yeah. Hey, Brent, this has been great. I really appreciate you breaking that stuff down for us and our listeners because, it's confusing. Taxes are confusing. And I mean, that's something that, like I say, we spend a lot of time on with clients, helping you understand it better. We think it's super important because we've always felt like that you can't separate retirement planning and taxes because if you do, you're missing a big part of what the benefit of planning, right? So as you look at your investments and your income planning and your taxes, whatever decision you make in any of those areas, it affects everything else. So
Yeah.
hopefully this is really helpful for everyone out there listening.
Yeah, I appreciate it. It was fun.
This has been a really interesting conversation to listen to. And just to pick up on your last point, Dan and Brent, I think a lot of people, when they look at the estate tax provision, they don't take into consideration, to your point, Brent, that if you own a business, it's really easy to jump past those estate exemptions. And, and it takes some planning. And, so people you don't ordinarily think of as, oh, hey, they've got an estate tax problem. Actually, they would or do. So it's a very, very well made point. Very well made point. Dan, for people who are listening to the conversation who would maybe like to have a further relationship with you, they're not your clients and they're kind of curious and they want to explore the possibility. What's the best way for them to reach out to you or get in touch with y'all?
Yeah, one of the things I'd like to mention right away is we do have some really, I think it's really neat software. We can do an evaluation on your tax return, like where it is right now, and then it'll allow us to even project forward, what things might look like in the future based on these rules that are now in place. And so that's number one. Don't hesitate. There's not a charge for that. We'll help you go through it and so you understand it because we believe it's really important. But in general, we recommend just going out to our website at averywealth.com. And it's just like the Avery labels, Avery, and then wealth, wealth.com. And we've got under our insights tab, we've just got a ton of valuable learning opportunities, lots of articles. There's downloadable checklists. There's all kinds of things that we feel like really can aid you in understanding these things a little better. And then just, reach out. We're happy to sit down, have a cup of coffee, just kind of talk through where you're at. And if there's things that we might be able to do to help improve your situation, and if there's a good fit to do that, you can always call the office at 517-783-1695, and we'll get something on the calendar, either a phone call or whatever you're most comfortable with. But yeah, there's a lot of room for improvement for most families when it comes to these things and integrating that tax planning in their investment and income planning. And we've seen the people just benefit a great deal, and we look forward to helping others do the same.
No, that is fantastic. And I would encourage you to reach out to Dan or Brent if you are not familiar with them. The other thing I would encourage you to do is hit the follow button on this podcast. If you're not a subscriber already, by hitting follow, you're automatically alerted every time a new episode of the podcast is released. One quick request for me. If you like this podcast, if you have found it useful, please tell other people about it. Word of mouth promotion is the single most valuable tool that one can have, and we would very much appreciate it. So until next time, I'm Bill Tucker. On behalf of Dan, Brent, and everybody at Avery Wealth, thank you for taking the time to listen today, and we'll catch you next time. Thank you for listening to Ramp Up Your Retirement. Click the follow button to be notified when new episodes become available. Visit our website at www.averywealth.com or give us a call at 517-783-1695. And don't forget to click the follow button to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Avery Wealth. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment plan. The opinions voiced in Ramp Up to Retirement with Dan Reese are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine what may be appropriate for you, consult with your attorney, accountant, financial or tax advisor prior to investing. Guests on the show may not be affiliated with CWM LLC. Views and comments by guests may not be representative of CWM LLC. Investment advisory services are offered through CWM LLC, an SEC registered investment advisor. Carson Partners, a division of CWM LLC, is a nationwide partnership of advisors.